Hello, everyone. Welcome to today's session. Let's jump right into it here. Market conditions. Let's start out with kind of that big picture that we like to start out with. That's ultimately this entire process right here. And that is where are we at currently in our current trend and the current market conditions based on the past 20 years and based on the last year. This trend momentum indicator sitting right here gives us the last 12 months, which is essentially, about right now it's about this chunk of space on the chart. Going back to April of 2023, I believe was when we had that crossover happening to give us this uptrend. And that's still where we're at currently. We're at the upper end of that range. This bottom number right here, bull market at 25.63. That represents this number right here. And as I've mentioned many, many times, anything above 20 is historically very, very overbought to the upside here. So we've seen that a few times. We saw that back here. We even saw it back before this COVID move. So we certainly know it's not it's just not at a sustainable level where it can continue to go much higher without some kind of flattening. It certainly could kind of come down a little bit. And who knows, it may go a little bit higher, but as far as staying there, that's just a problem. We just have a problem as far as where we are at in the current relationship to the current trend. Shorter term, we have now when I say problem, I just mean that the probability of continued upside without some kind of a retracement, a significant retracement, is on the table right here. Now, whether that unfolds, the issue of how that unfolds is it going, what's going to be the catalyst? Is it going to be recession? Is it going to be inflation? Is it going to be both of those? Is it going to be something else? Some kind of an outside event? Is it going to be the election? Is it going to be what could be the catalyst for downside? What could be the catalyst for more upside? Remember that stock market and stock prices, this is a representation of the S&P 500. So 500 of the world's largest, best companies. The average price, in essence, it's a little bit different than that these days with market cap weightings and different things there. But in essence, it's just the average price of the S&P 500 stocks. And so those are designed, as I've mentioned before, the design of a stock is to go up. The design of a company is to grow. Companies are not designed to be flat or to do nothing or to go down, at least profit generating companies. There are obviously other companies that are designed for various reasons other than a profit motive, but the profit motive is baked into 99.9% of companies. There's no way to grow without having profits. You can break even for only so long, but they have to grow and they have to continually grow. And when they don't, the stock price no longer grows, and if the company is not growing, neither is the stock price going to go up. So there's always that core bias underneath what is happening with stocks. And that's in my opinion one of the great things about stocks and why to trade them is because, particularly using a momentum bullish strategy, is because these new great amazing innovations, and we get them every 20 years. We get something new and cool, maybe even sooner than that these days. It's just happening exponentially, where we had not even 4 years ago, 5 years ago, it was cryptocurrency, and now we've seen AI. And what's the next thing going to be? Is AI going to help create the next big thing? Whatever that is, it's always exciting, and there's always opportunity there. And the stock market is a fantastic place to be able to find that. That being said, the stock market is a marketplace of buyers and sellers. It's a bidding, it's an auction for what we think the price of Apple should be, or what we think the price of Nvidia should be. Okay, all of us individual investors and traders, that includes large institutions, that includes pension funds, hedge funds, mutual funds, large family organizations. It's just trillions and trillions of dollars that are ultimately controlling the stock market, and those overshoot. Okay, we get too much greed pumped into the market, and we get too much fear in the market. So we get these cycles where ultimately, the trend is continually moving higher, but we get these massive ebbs and flows of the market, which create volatility, create some stress, create some gains, create some losses. And our challenge obviously is trying to be on the right side of those trends. And in terms of stock picking, pick companies that are working, pick companies that are going higher, pick companies that have momentum, that have some backing, institutional backing behind them as well. In the shorter term, we're now to the upper end of that range. We're not extreme on momentum. We had been to the downside extreme and then rallied back up pretty effectively, pretty quickly, really a straight shot. That's an interesting price activity because it also pulled breadth with it, meaning this number right here. It pulled a lot of stocks are participating now, a lot more than had been in this last rally. So right away, early stages of this trend. So that's an interesting part right here of what's happening in the shorter term is we do have a little bit broader based participation happening in this rally. Sentiment shot from, sold off to immediately right back to where it was. And so essentially we're sitting right back to where we were a month ago, and not a whole lot has changed, honestly. I think we had a little bit of fear come in based on recession that spooked the market, that the Fed couldn't cut or wouldn't cut, or if they had to cut, it was based on recession instead of a fix of inflation. There are two sides to that interest rate story. One is good, one is not so good. Okay? And the not so good one is if the Fed has to cut rates because the economy is now in recession, that's a problem. It's a problem that they've created because they kept interest rates too high for too long. I wouldn't be surprised if that is the case and going to be the case. But stranger things have happened. Okay, usually the markets, they're never the same, but they always rhyme. They're very similar in terms of what what an economy can do to grow. There's only so many things that it can do to grow, and you have different areas of productivity, which companies are always working on that productivity. Then there's just the cost of money. There's the cost of capital, and there's the cost of debt. There's the cost of borrowing and deploying that capital, and that's interest rates. So there's the lower those costs can become, whether it's getting debt for growth and expansion and new buildings and things like that. It's just a massive overhead lag dealing with interest rates. We'll see what ends up happening in terms of where we're at right now. We're focused on what the market is doing versus what we think it should be doing. Okay, right now what it is doing is we've got good breadth, we've got nice buy-sell ratio. It's moving off of a really significant low in terms of a very fast sell. I shouldn't say it's significant, but it's a fast enough sell-off and reversal that came right back in again. Let's go to that 1-year time frame. That we had a pretty decent correction. I think it cleared out. Remember what the point of a correction is. The point of a correction or counter trend is to clear out the weak hands, to clear out the sellers, or to create, in essence, to create new demand. Okay, you have to create, in order to create new demand, you have to get rid of pent-up selling pressure. And so when that happens and we start to get some selling, and sometimes that doesn't fix itself like this. Sometimes it just counter trends back up and rolls over, and we ultimately get a little bit deeper retracement. If we go out to that 2-year time frame, you can see back here a little bit. Let me remove the volume off of that so we can see it. Get a little bit deeper retracement, more something like this or something like this. And really in the last few years, minus that last bear market that we had a couple of years ago, has really, we haven't had anything as intense as that since then. So these have been relatively weak or healthy retracements, normal counter trend retracements, buying the dip scenario, and we saw pretty aggressive buying around this area. So now here we are right now. This is where we're sitting after a really fast, sharp move back to the upside. S&P 500 has now got a range between this 554, 565 range, and watching for that to hold up. It could dip back all the way back down to that 236. And wouldn't be of concern. Okay, now we're in the momentum zone back again on the S&P 500. We could have some retracement, but now we're watching for some support. What we want to see too, the other little bit of bearish concern is that this just went straight up with just almost no counter trend at all. That's okay, but we could get a little bit deeper retracement. But we've got breadth. We've got a lot of things pointing to the upside. A little bit of slowness now on the last couple of days, but we're also seeing a lot of these commodities across the board, short-term trends are up. Most of these signal trends are either buy or hold, nothing in the sell range. And you can see just in the last month, 2 months, we've seen some pretty nice moves here on these utilities. That's up 6%, being the biggest leader here over the last, really had a day or two of downside during that correction, and is continuing to be moving higher. So see, that is utilities. We're seeing commodities also continue to show strength here with gold. Gold just, this is a really nice looking momentum chart pattern. When you have that 6-month time frame, we're up above the 236, and we're just kind of gradually churning higher, and we're tucked up into this upper corner right here. Okay, a lot of times when we're looking at a chart pattern can be misleading, and it can actually sometimes hurt our analysis, because not the chart, but the way that we read the chart, because our brains don't like this. Our brains don't like to look at something that is right here that has a ceiling on it. It says, oh, we're going to hit the resistance. We can't go any higher. Why can't we go higher? Because our brains can't see past that chart right now. Okay, so as of right now, we've got to be able to say, this is the direction that we want it to be moving. Okay, and sometimes it's a good practice, and I like to do this. Let's find a little bit stronger uptrend. We look at WGS. Okay, if we go back a little bit back here, and if you kind of go through this practice to help kind of let your brain focus on this upper corner right here and say, what do I need to have happen during this uptrend? Well, it's got to look like this. Oops, let me go back here. I'm going to leave this circled. But if I go a day here, okay, it moves higher. Okay, just notice how this chart shifted. Now I go another day, it's even higher, another day. Okay, and it's just continuing to move higher. And then you get that retracement to come back down. This is a normal counter trend move here. Ultimately, now I'm looking at this chart saying, can it go any higher? Okay, we get a retracement, we get a pullback. It's doing its dance. It's doing its volatility dance inside of this range. But ultimately, this is the trend direction that we want to continue to focus on. Give it another day, pulls back, retraces, probably a stop out, reverses. Now we're back into the upside. Okay, so we're looking at this chart as the expectation is that it's continually going higher. That's what we want. When it doesn't, we get stopped out. In fact, I think on this exact trade, we did get stopped out somewhere around here. Okay, now I want to talk about two things with that. One of them is profit taking. Okay, and with stock trading, taking profits or taking the gains or capitalizing on the gains it's a double-edged sword, right? Because there's two things that can happen. Let's say that we have an uptrend, we have a counter trend that moves like this. This is our 236. We get a confirmation bar, and now our initial stop loss is set right here. Now we're moving higher. Okay. Well, let's say we've now got a 10% gain, and we say yes. Let's cash in. Okay. Let's take that 10% and call it good. Okay, that's great. If that is your plan, that is 100% fine. That is 100% perfect. It's exactly what you can do and should do if that is your plan. I get a 10% gain. I'm cutting everything loose. I'm moving on to something different. Okay. Now, but what happens is we start having doubts or questions, and we say, well, what if I sell everything and this thing immediately rockets 50% the very next day? And if that hasn't happened to you yet, it will, okay? Because it seems like every single decision we make and can make, the market will make us feel like idiots, okay? Or the market will punish us in some format, okay? And one of the ways to be punished is to get out too soon of the entire position and miss out on upside. I think missing out on upside is more painful than getting stopped out or losing on the downside, because you had it right. Okay, getting it right, that's half the battle sometimes, and then getting it right big is tough to do. That takes 2 or 3 out of every 10 stocks, you might get a decent pop like this that really gives you a good move. So the question is, how can I try and get the best of both worlds? Is there a way for me to still hold on to some of the position going higher, but also lock in some of the gains, and then also protect my downside? Okay, so that's ultimately in the wheel methodology. That's what we're trying to focus on, is how can we capture some to the upside? How can we protect our risk to the downside? And how can we still be in the game for massive upside? Okay. And so with the trading plan, let me jump over to back to this page. Let me see. Yeah, on our trading plans here, go over to, I didn't want to go there. I wanted to go here, and I wanted to go to a trading plan. Okay. Now, one of the things that we can focus on exiting is this process right here, selling 25% of the position at a 25% gain. Okay, so let's talk about that first. And that could be done, you can change that to be anything. You could change it right now, you know, market conditions are a little bit toppy. You could change that to be 10%. So going back to that example, here's our upside, here's our counter trend, here's our support, 236, here's our confirmation bar, here's our stop loss. We're moving higher, higher, higher. We hit 10%. Well, what can I do here? Selling into strength, okay, at 10%. And again, I've listed in the trading plan at 25%. This can always be adjusted based on market conditions or based on your own, your own skill set or your own trading plan, or just flat out saying, I'd rather capture more gains. It's good for my mental constitution to capture gains a little bit earlier. There's nothing wrong with that as you're developing and learning what your individual risk tolerance looks like and feels like. Or if you've continually run into issues in the past where you're like, I just can't do it. I can't hold on to these retracements. I can't hold on to these things as they're moving higher. And then they start to go higher. And I'm thinking, I know I should be selling it, but what if it goes higher from here? Or what if it drops back down? Or asking all those questions. The best thing to do is ask those questions before they happen and say, okay, if I get to 10%, I'm going to sell 25% of my holdings. So if I own 100 shares right here, okay, and that 100 shares hits 10%, I'm automatically selling 25 shares or more. I could do 50% or whatever that is, so that I'm selling into the strength. Now, there's no way to get the best of both worlds all the time. You have to compromise. So what am I doing? I'm compromising by saying I'm taking half or some of the money off the table. That leaves me now with 75 shares. Okay, and that 75 shares, I'm going to use a trailing stop. Okay, so now that we're up to this level, I'm adjusting my trailing stop. And again, that 236 trailing stop works great. Now I've at least captured some of the gains. Okay, and if I wanted to capture more, I could. There's nothing wrong with that. Again, there's nothing wrong with however you decide to adjust your trading plan so that it's comfortable for you, because there's no perfect way. There's no exact way. There's no riskless way. There's no way to get without taking more risk. It's impossible to get more return. So in order to do that, you have to be able to willing to pay the price of holding on to all your shares for longer, and that is you might get stopped out. Okay, but you might not. This thing might do this and rocket and head higher, and ultimately you've got a fantastic winner. It's hard to do. Okay, it's hard to do, and it takes time. It takes time for a stock to move higher. Let's jump back. I'm actually going to open up this and go to here and take a look at this current trade. Okay, so ASTS is a good example. This is one that has gone from $4 to $30. That's 800% just within this current trend. Okay, now going into this, we sold positions here. I believe we sold positions here. Don't think we've sold anything yet, but we still have shares in this trade, and we're using a trailing stop. So we've also had scenarios where we've sold here and it immediately tanks. So we're saying, thank you very much. I'm glad that I sold. When it rockets higher and you sell the entire position, you're thinking, gosh, damn it, why did I do that? Why did I sell everything? Because I didn't, now I missed out on that possible gain. So again, going back to that adjustment, selling into the strength at a certain location. Okay, let's say that it's 25% and I'm selling 50%. You can sell 50% each time you hit a level. You hit 25%, you sell 50% of your shares. You hit a 50% gain, and you sell another 50% of your shares. Okay, and you continually sell 50% of your shares until you hit a certain point, and then you're just trailing the stop loss. Now it's like, all right, I've got enough gains on the table that I'm willing to give some back. This is our stop loss on this trade right now, right at $30. And if it finds some support, it's looking like it could, but it's also looking like it may retest that level and head higher. Who knows? We might get one of these. We might get one of these. Crazier things have happened that we don't want to get out too soon. But we also want to not be stupid and put all the money all on the line all the time. So my point is that we can do various things along the way, and we're going to, because we don't know the future. And when we get a scenario when we get a stock price that looks like this, and we're thinking, holy cow, man, this thing has just gone from 20 to 40 in 3 days. What should I do? You know, should I sell everything? Should I just use a trailing stop? And then if it retraces back from 38 to 30, then I'm thinking, well, okay, at least I didn't XYZ, and then it finds some support, and then it rockets higher. Okay. I would imagine most of you, if you've been doing this for any length of time, have experienced some of these emotions that come along with when to buy, what to buy, when to sell, and then how to manage those trades effectively. So in order to try and get the best of all of those scenarios where we want to be able to have shares, this thing may go from $4 to $250 all within the same trend. More than likely not. More than likely it's going to get some kind of a retracement at some point, a correction, pulls back, stops out. Okay, what we don't want to have happen is we don't want to have a stock that goes like this. Okay, it's getting to this point now, and we say, okay, we're up to $40, and everyone and their grandma starts to come back and sell it again, and now we're back here again. And now we're sitting back here at $10, scratching our head thinking, what just happened? I had these gains and I'd let them all go. Okay, why did you let them all go? It's because there was no plan in place. There was no structure to say, why should I sell into this strength, or should I sell into strength? I've heard this, or I've heard that, or this is bad, or this is whatever. Okay, you've got to make it based on you personally. There's ways to do that and be able to capture. I like to capture some of the gains on the way up because I've had this happen too many times as well. And these are the kinds of stocks that do it. The ones that go straight up come straight back down. The vast majority of the time, there's very every once in a while you get an entirely brand new technology and a new company that really rockets and takes off. This is a wireless space cellular company. They're putting satellites in the sky for mobile use, for cellular phones to be able to connect to the satellites instead of the cell towers. So cool idea. I've read that they don't even have a satellite in the sky yet, though. So like it's this idea still. But it's working. As long as the idea is working and people are bidding that price higher, I'm willing to take a shot at it. Okay, so again, going back to the trading plan. Oh, I already had that open. Is making sure that these processes you've got a process. The other is to rebalance. If you've got a winner that has moved, let's come back to this chart. Let's say that I had a winner that went from, typically our allocation is right around 2,000. So let's say that we doubled it from here to here, and now we've got 4,000 of gains. Okay, we can rebalance that back to our 2%. Okay, by essentially selling all of our profits. If you think of it like that, I don't like to think of it like that. I prefer to think of it as I'm rebalancing my risk. I'm just moving these gains back to cash so that I have them. Now I can keep them. Now I'm letting the stock still continue to work for me, but I'm just harvesting some of those gains. You don't get as much of the compounding effect as you would with a full position, but you also have to just plan on the fact that some of these are going to work big, some of them are not, most of them are not. Most of them will give us average type gains that'll still be nice gains, but the few that do really take off, we want to make sure we capture those. This is also a way to be able to do that, is looking at your portfolio allocation and saying, this stock is now, instead of whatever percentage, 2%, maybe it's bumped to 4%, and this number is 4,000, and that slice of my pie is getting a little bit bigger. We don't have any that are really out of whack right here, because even ASTS, we've actually got a smaller position size because we've sold off shares along the way. Okay, and that's one of the ways to be able to do that. So we get, when we get a new trend starting, we're getting these 10, 12, 14, 15%, 20% gains. market conditions right here, it's very tempting, and it's okay to do that where you've got several winners that are in that 10%. Say, I'm going to start to sell 25% at 10% or 15 or 10 or whatever that number is. Start out with a number, be okay with it, try it, test it. Say 10%, I'm going to sell 25% of my holdings at 10% so that I'm selling something into strength. Okay. We want to sell something into strength. Okay. RKT, this is a good example. Our entry was here. It's come up. We've got a stop loss sitting right here, but it's getting to that point. It's hovering right around that 20% where we want to start to sell something into that strength and not wait for it to stop out every single time. Okay. There are statistics though that kind of show that most of the time, if you just leave your strategy alone and leave your stop where it is, that it's going to average out. You're going to get the big winners. It's going to continue to move, and there's going to be some that stop out. So it really becomes a scenario of how can you manage your own emotions? How can you manage your own decisions so that you're doing something significantly, you're doing it the same way each time. Okay? And that way you just remove a lot of the emotion, you remove a lot of the decision making so that it's not an emotional event to say, gosh, why did this or that, or why didn't I do this, or I should have done this. And we're still going to get those scenarios. That always happens, but the more you get focused on your trading plan and the more you're understanding what you need to do and when you need to do it, before that happens, then it's a lot easier to do while that's happening. If you'd like to join me in the Discord room each morning, I've got a link at the end of this recording, just in the footer or in the Learning Center. It's also in the Learning Center just right up here at the top. And you can get access to that where we talk about these each morning. We talk about the trades, the entry, the location, we manage the stop, we focus on where we're selling. We essentially follow this trading plan. And if you're feeling like you need a little bit more structure, then join us and see if that can help add into that routine. It's just a routine and it's just a structure. And a lot of times you may follow me for a month in this routine and be like, okay, I get it. I get what's happening. I can see what's happening. I understand now my brokerage platform. I understand my stop loss locations, and it just takes practice. It just takes repetition and routine and a plan and following that plan so that you're able to understand what are your goals, what's the risk that you're taking, what's your allocation, how are you taking gains, how are you setting up stop losses, all of those things, and add some structure so that it doesn't become such an emotional event. It's already emotional, dealing with trying to grow our money and to get it to grow and finding ways for it to grow. Stocks are an amazing vehicle to be able to do that. And it's just the toughest part is managing the market and the risk. And those are obviously we can't manage what the market is doing. We have to play with what the market is giving us. And sometimes those situations are good market environments where stocks are moving higher and there's a lot of demand for them. Other times when they're retracing, then some of these speculative stocks really get clobbered. Okay, and well, we just have to be aware of what those market conditions are as well. That's why this is important to say, what's my buy-sell ratio? What direction are we headed? Should we be loading up a little bit more aggressively on holdings or a little bit lighter? I still am right around that 25, a little bit higher than 25% right now, and be watching for those are kind of the current market conditions that are that we've got right now. I'm going to end on that note. I appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.